I think really it comes down to two things. It comes down to we follow a very different strategy than most. And also, I think it's thanks to temperament. When it comes to investing, temperament is extremely important. You want to be somebody who doesn't care to go with the crowd, but also doesn't care to go against the crowd. An interesting point is many people think that, I mean, they know the concept. You don't want to be a crowd follower when it comes to investing. Something is going up and you buy it because it's going up. And ultimately, that's not a profitable strategy. But what they do is they correct themselves by going against the crowd too. They become contrarians. And that is also not the answer. The answer is to be independent. In other words, if your facts and reasoning are right, Ben Graham would always say, and that leads me to my strategy. We follow Ben Graham. But Ben Graham would always say, if your facts and reasoning are right, you'll make money. And if they're not, then you won't make money. If you understand the business really, really well, and you're buying a good business at a good price, you're going to make a lot of money. If the crowd likes it or doesn't like it, won't make you right. And if the crowd likes it or doesn't like it, won't make you wrong. It's not going to help you. It's not going to hurt you. But in other words, you've got to analyze the situation yourself. And you've got to come to a conclusion based on facts and reasoning on your own. And once you make that determination, you have to act accordingly. But my point is, whether the crowd is with you or the crowd is against you should not make any difference. We follow Ben Graham's approach to investing. And Ben Graham is best known as Warren Buffett's teacher. He was a teacher at Columbia, and Buffett got his MBA from Columbia University and was in his class. And he was by far and away the best student. Apparently, every question Graham asked, Buffett was the first one to answer. And he really developed a very strong connection to Graham. And Graham also ran an investment firm himself in the 40s and 50s called Graham Newman Corporation. So actually, in 54 and 55, for maybe a year and a half, Buffett actually worked for Ben Graham. And that was part of how he developed to then start Buffett Partnership in May of 1956. Which he wrapped up in January of 1970, and then developed Berkshire to what it is today, a $700 billion company. It was $15 a share when he took over Berkshire Hathaway in 1965, and today it's maybe $500,000 a share. They're all publicly traded. And Ben Graham, really to summarize his whole philosophy on investing, Chapter 20, there's a single line, and I would consider that single sentence to be the foundation of everything we do at BlackBird. And that is, investing is most intelligent when it's most businesslike. And what it means is the vast majority of Wall Street thinks the way a gambler would in a casino. And Ben Graham is telling us, don't do that. Buy a stock the exact same way you'd buy the entirety of the business if you couldn't sell it for 10 years. And what that means is, you ought to think about it exactly the same way a business person would. If you listen to CNBC and you listen to Jim Cramer saying, this stock went up today, how do we play it tomorrow? Could you imagine an apartment owner, somebody who owns a 100-unit apartment building saying, somebody offered me 3% more for my apartment building today, how do I play this tomorrow? Of course, he wouldn't think about it that way. He'd think about how many units are filled, what's the vacancy rate, he'd think about how much am I charging per unit, what are my expenses looking like? Those are the things that's what his mind would be on. The actual underlying property, what are the operating results of that asset? In the same way a business person would think, how many customers am I bringing in? What are my expenses? What is the cost of goods sold? What can I do about that? Can I bring it down a little bit? What can I do about my operating expenses? That's what a business owner thinks about. So there's really 5 things we're looking for when we're making an investment. And I think these are the same 5 things I'd be looking for if I were buying the entirety of the company and couldn't sell it for 10 years. Number 1, it has to be something I understand thoroughly. Number 2, they have to possess a durable competitive advantage. Number 3, they have to have a star management team in place. Number 4, they have to be conservatively financed. And number 5, they have to be available at a good price. Number 1, it has to be something I understand. Obviously, if I don't understand the dynamics at play, I shouldn't be buying the entirety of a business. I shouldn't be buying an apartment building if I don't understand the neighborhood. I don't understand the factors that'll impact the long-term results of that investment. So I have to understand the business characteristics inside and out. That's the first thing. Without that, the rest doesn't matter because you'll never come to a real answer on any of the other characteristics. The second most important thing is they have to possess a durable competitive advantage. And without it, it's not a good business. By definition, a good business must possess a durable competitive advantage. And basically, in a capitalist economy, anytime a company is earning excess returns on invested capital, in other words, they're doing well for themselves, that's going to attract competition. But if you look at any business, it's doing very well, they're earning high returns on invested capital, it helps the consumer big time, but it's detrimental to a business when competitors step in and therefore compete away any excess returns that you earn. And so, as an example, if we both had a bagel shop and Judah's Bagels, you put in $1 million, you were earning $400,000 or $500,000 a year on that net, you'd be doing really, really well and earning 40-50% returns on invested capital. That'll draw me in. I'll open up a bagel shop just like yours. And assuming you don't have a durable competitive advantage, in other words, you're selling a commodity type product and I can replicate that, then two things. Number one, you're going to lose a lot of business, and ultimately that will prevent you from continuing to earn excess returns on invested capital. Like we said, 40-50% return on that $1 million that you've put into the business. And so we only want to own a company that possesses a durable competitive advantage. Now, here's the interesting thing. Almost every company will claim that they possess a durable competitive advantage, but most companies are lying. It's only a select few, a very, very select few. As a percentage, I'd say it's well under 5% of businesses across the country and across the world that truly possess a strong, durable competitive advantage where the competitors are not able to replicate the product or service. So when we're making an investment, and I mentioned this previously, but we're looking at 5 criteria. We're looking, number one, it has to be a business we understand. And by the way, most businesses, I'd say the majority of businesses, I don't understand them well enough to make an investment. And that's the first, right away, they can be eliminated for that reason. Number two, they have to possess a durable competitive advantage. And as you know, most businesses don't possess a durable competitive advantage. Number three, they've got to have a star management team that acts in the interest of shareholders. And in many cases, when we make an investment, the CEO and the management team themselves have a very high portion of their own net worth invested in the company right alongside us. And they've got to be conservatively financed. And lastly, they have to be available at a bargain price. Now, if you think that an opportunity that checks all 5 boxes comes around every day or every week or every month or even every year, sometimes it'll be more than a year, and I'm looking through hundreds and hundreds and hundreds of businesses, putting in thousands of hours, and maybe it'll take a year, 2 years, and I'm reading maybe 200-300 pages a day, and after 2 years, there'll be one that makes a lot of sense and checks all and meets all our criteria that we demand. One of the questions I get all the time, especially recently, is, Judah, is there going to be a recession this year, next year? And my answer is, I don't know when the recession is going to be, but of course there's going to be a recession. And if you're in a capitalist economy, there's going to be a recession. If you have a communist economy or a socialist economy, it works differently. Of course, you're basically always in a recession then. But if you're in a capitalist economy, it works wonders, but there will be hiccups along the way. A capitalist economy works wonders, and it helps society. I mean, if you want society as a whole to have the highest quality of life, a capitalist economy is the way to go. But it does come with recessionary environments. It's part and parcel with that economic structure. And so there's going to be a recession. And by the way, we have all this instructive art, and it shows not all, but most of the financial crises and recessions over the last 100 years, including 1929, which of course was the worst depression ever in the United States history, all the way to COVID in 2020. It'll happen again. In fact, if you wait another 100 years, you'll have, maybe a dozen or who knows how many, but you'll have all sorts of recessions. I don't know when they're going to happen, but what I do is I never want to be vulnerable to a recession damaging me, damaging our clients, damaging our firm. And so part of it, I mentioned earlier with our strategy, one of the things that we insist on one of the things we absolutely insist on when we're making an investment, we want them to be conservatively financed. In fact, our largest investment today has absolutely no debt, but you've got more than $50 billion of cash. What does that mean? In a recessionary environment, credit markets freeze up. And if they had a lot of debt, they'd have to because basically most companies have a huge chunk of their capital structure in debt, and they issue all sorts of bonds, and those bonds mature gradually over many years, and suddenly you have a big set of bonds maturing, and you have to refinance and issue more bonds to then pay back, those maturities. And if you happen to be in the depths of a recession, you're not going to be able to issue those new bonds, and you're not going to be able to refinance your debt. And what happens to the shareholders? Well, you go into Chapter 11 bankruptcy, and in many cases, the shareholders are wiped out. So I'm more than willing to forego the upside, the benefits that leverage provides, which basically it magnifies your results so that we're not vulnerable. And in fact, we're in a strong position to capitalize when a recessionary environment arrives. So if you think this company that I discussed, they have $50 billion of cash. What happens in a recessionary environment? It puts them in a much better position to then buy out one of their competitors, to make various other acquisitions and mergers. It puts them in a much better spot when they're buying back stock, and they buy billions and billions of dollars worth of stock back. In other words, we're buying out our partners, we're increasing our stake in the business, and at a lower price, every dollar, if they're going to buy $10 billion worth of stock and the price of that stock is lower, we are essentially growing our stake in that business at a much faster pace without us laying out a dollar. Or they can send us a dividend. If we receive a $5 million dividend from them, we can use that to buy more stock, either of that company or of another one. But of course, if prices are lower and markets are in a recessionary environment, it puts us in a better position to buy at much better prices. And so when everybody's flush with cash and the economy is roaring, it's very difficult to find an opportunity. Suddenly we have all this cash coming in and the prices are lower. It puts us in a great position to make those investments. If hypothetically I could press a button and eliminate all recessions over the next 10 years, we'll do worse. I wouldn't press the button because I think we'll do better off. BlackBird will be in a better position with recessions over the next 10 years, and they will happen. I guess the good news for some and the bad news for others, but they will happen, and we will be better off with those recessions than without. When an investor comes on board, we're looking for investors that are in sync with our investment philosophy. When we buy into a business, we're looking to buy it for many, many years. And in the same way, we want investors that are looking to make an investment for 3 to 5 years at a minimum. But if they want to make a redemption, they can. It's always available to them, and they can make a redemption and take the money whenever they want.